Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Are the cash values net of fees, or are there other costs I have to take into account? Okay, so the cash values of all life insurance policies are net of the whatever fees, commissions, policy charges, what you see in the illustration under net cash value is what you have available to you right now. Okay, so what is this term blending thing about? Why is it on my policy? Okay, so term blending allows you to lower, basically it lowers the cost of the overall cost, like the all-in. I would say cost, really it's more like it lowers the total overall in premium amount. In a sense, I guess in the early years of the policy, it can lower the overall cost. And also it lowers, as I said, the total premium. And it also allows you to pay more. You could basically use it for two things. You could use it to try to lower the total premium for the policy, or which is traditionally how it was done. And that was the initial reason why carriers came up with this, supplemental term riders on these policies. It was a way to kind of sort of compete with universal life, which was a term blend, or was it not term? It was like a combination of 1 year term and a cash account. And the carriers that were selling whole life insurance, they didn't really have anything like that. So their way of competing was to say, hey, we've got a way for you to term blend. Like you can bring in a supplemental term policy into your whole life, and that's going to, quote unquote, lower the cost. It lowers the premium, so you could have a larger whole life policy, overall, and some of that could be term insurance. This is going to have a lower premium. At some point, that term insurance either has to be dropped or it has to be converted. Or you can use it the way that, I use it, and some other, not a lot, I say some. It's actually relatively few agents. I mean, I know a lot of the guys who do the term blending in the industry. You do it to increase the amount of paid up additions rider premium that can be paid into the policy. And this in turn helps boost up cash values faster than you otherwise would be able to do. So you get lower base premiums, more flexible premiums, more POAs. What's not to love? There is one risk that I don't see, hardly anybody talking about, really. The primary risk of term blending is this. By the way, I say this as someone who I have term policy, or I have whole life blended whole life policies myself. I own them. I sold them to other people. I design it regularly. That's how I design things. But, I also cover the risk. The primary risk is if you don't pay enough into the policy to get rid of the term, I say convert, but it's not really. In most policy contracts, converting the term is not really what's going on. They kind of use that term, I don't know, loosely. They say, well, you're converting the term. You're not actually. If you say convert your term on a blended term, they think you mean that you want to take the rider off the policy and convert it to another policy. But really, you're like, it's kind of like buying down the term portion. So you're building up the paid up addition side and buying less and less term over time. If you don't do that, those term costs can continue to rise, and they can cause trouble later on because they don't look like a lot, but after age 60, 65, they start to add up, and as the cost starts to go up a lot on us. So some companies will actually force the payoff of the quote unquote payoff of the term portion. They do that by baking it right into the term rider. So an example of this would be as of this recording, because in the future maybe they'll change it or something, but as of this recording, the Penn Mutual life insurance company, they do this with their flexible protection rider, and they basically force the payoff of the term rider. Most other companies don't do that. I mean, there's a company, New York Life does something similar with the dividend option term, although it doesn't actually pay it off. You're just paying the premium for a certain point, and then you could say, I just want to pay the term for a certain number of years. When it's done, and it drops off. But most other carriers have this thing where it's very flexible. You can just pay the term premium on the rider, and you don't ever have to get rid of it. And sometimes it's designed so that it just kind of stays on there for a long time. Either way, the goal of the term rider is to use it to kind of open up a higher MEC limit, because you have like a really big death benefit, but the premium is really small for that. So you can actually put more premium in, which that's the whole point, right? So if you buy $1 million of supplemental term and it's only costing you $100 a month, you can dump additional premium into that on top of the small term and still not hit your MEC limits. That's kind of the whole point of doing that. So, and by getting more of that premium into the policy, again, you get rid of the term policy faster via the paid up additions rider, which replaces that term insurance, and with paid up permanent life insurance. So whether or not it makes sense to use a term rider depends entirely on your goals for the policy. So, and it also depends on the policy. Like some carriers, the way that their policies are built, the term rider is only useful in very specific circumstances. Other companies, they kind of build it in. So like if you want an accumulation driven product, you almost have to use the term rider. Whereas other companies, it doesn't work that way. And some companies, it depends on the age too. Like there's one company in particular where if you try to use a term rider, a term blend on a juvenile, like a child, if you saw like parents and grandparents want to buy, they want to buy insurance on their kids. If you try to do term blending on a child, the policy doesn't perform very well. But if you do it on somebody in like their 30s and up until maybe their 20s and stuff, but if you use it on somebody who's in their 30s and 40s, the policy actually performs better. And sometimes you don't even need to use it, depending on how big the policy is and what kind of premiums and stuff you're putting in there. Sometimes you don't even need to use a term rider, just because it's not necessary. The way the policy is designed, you don't really benefit from it. So it just depends. I only want to pay premiums for 20 years. Why does my contract state a payment period of 52 years? Okay, so this is it's a mismatch between the planned premium and your guaranteed level premium. And every single whole life policy has what's called a guaranteed level premium. And that premium is due on the policy every single year until maturity, until you either have to do a reduced paid up and have like what's called a limited pay policy, or you got to pay it until the contract ends. That's by design. That's why you're getting the guarantees and why the product is so safe. Most policies that I design for clients have a long payment period. Think of a payment period as a sort of billing period, okay? This is a block of time that you can make premium payments, but it doesn't necessarily mean that you have to make premiums out of pocket during the entire time. Now, you have to make premiums, but you don't necessarily have to make them as out-of-pocket premiums. There's different ways to make a premium. So with a traditional whole life product, your guaranteed level premium is due every year, usually to age 95, 99, or 100. Those are the typical ages that I see. In some cases, to age 121, I don't see that as often. There are some carriers that do it, but with most of the policies that I design for clients, you have the option to elect a premium offset or a reduced paid up status. So you can either pay premiums out of pocket. Well, I'll get to that later. So if you elect, so just to back up just a second, because I realize maybe some people don't understand those terms. So premium offset means that you can use accumulated paid up additions and current dividends to pay the current premium. So every year your whole life policy earns dividends. Those dividends could be used to pay the premiums, or they could be used to buy paid up additions. Okay, if you've already purchased a lot of paid up additional insurance in the past, you have a lot of accumulated dividends, a lot of accumulated paid up additions. You can surrender those to pay the base premium. So you surrender those, your death benefit comes down. Then you use them to buy base policy premiums. Your death benefit and cash value go back up again. And especially if you've aged into the policy a lot, the net effect is nothing, or sometimes slightly positive. So you can turn this premium offset option on or off every year. A reduced paid up status is the other way to do this, and that means that your insurance company figures out how much death benefit can be supported by the current net cash surrender value of the policy forever, right? And then the insurer just reduces the death benefit of your policy to match that amount. And then no further premiums can be paid into the policy. So if you only want to pay premiums, let's say for 20 years, you've got a few options. First, you either make your policy a 20-pay policy. You pay guaranteed level premiums for 20 years. You don't get any flexibility. Premiums can't be changed. The death benefit can't be changed. And this is by far the simplest option, but it's also the least flexible. You pay the premiums. If you don't pay the premiums, you're in trouble. Second option is that you pay premiums for 20 years and then you elect a premium offset to pay the premiums in years 21 plus. Okay, so each year you can decide whether to use the premium offset to pay the premiums or you can just pay the premiums out of pocket, right? As long as there are sufficient dividends and accumulated paid up additions in the policy, then you can continue with the premium offset indefinitely. If the policy values are insufficient to pay those premiums, then you're going to have to go back onto paying premiums out of pocket. And that's the deal with that. It works when it works, and when it doesn't work, it doesn't work, right? So, and now if you've paid in enough premiums, now realize that this is never going to be guaranteed. However, if you've paid in enough premiums, you've been paying premiums, or you've got like super high cash value, like you've got a blended term and you've paid in, so like, I don't know, tens of thousands, hundreds of thousands of dollars into the paid up additions rider, and your base premium is a small part of that. Even though it's not guaranteed, you've got so much paid up additions that the likelihood of you ever having to pay out of pocket premiums again is going to be very low. There's so much cash value, and the momentum, let's say after 20 years, the momentum is so much in your favor. It's not guaranteed, but it's pretty close. It's very, very unlikely that anything would go wrong in that scenario. So the third option, to get to the third option, is that you elect something called a reduced paid up status. And then let's say after 20 years or something, 20 or 25 years or something like that, 30 years. And then you do that, and then no further premiums are due. And you can't pay anything in, right? But you don't owe anything. So those are the basic options. So you basically will either have to pay cash, pay not literally cash, but like you write a check or something. So you would either have to pay out of pocket for your premiums or elect some other non-forfeiture option. Anyway, that's all I have for this week. Thank you again. Keep those questions coming, and I'll see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.